Welcome, fellow investors. This video is a suggestion from a subscriber left in the comments, as anyone can do, wanting me to analyze a stock. And this one's really interesting, Treasury Wine Estate. It's a stock that I have a love-hate relationship with. Love it when I made a bit of money and absolutely hated it when I got it terribly wrong. And interestingly enough, in my previous job, I had a partnership. We had a commercial partnership with Morningstar, who were also quite bullish on this stock at around that $9-10 mark, and we are nowhere near that now. So interesting stock to pick. And again, the methodology that we use is going to be that combination of art and science. The science part, looking at the earnings per share and looking at the numbers, and the art, taking and having a look at that human behavior. So we're going to have a look at the price to earnings ratio and going to have a look at the earnings per share and coming up with a range on where we think the price is. Now, as always, this stuff is educational only. It's not advice. If you are going to place a trade or make an investment, do your own research, double check everything, and get some advice from a financial planner if you need to. This is purely for entertainment, education, and walking through in a process. So, as always, the first thing we want to do, we want to go through and have a look at the historic price to earnings ratio of this stock. Interestingly enough, we always have to look at these. Based on the discounted cash flow method, it's 72% undervalued. So very interesting there. So we come to the price to earnings ratio history here. We're going back 5 years, and what we want to do is we want to try and eliminate these outliers, because that's just a period of time where investors, technically paying 100 times earnings, but I'm assuming earnings are going to have dropped at that period of time. So this one we might go to an external source, or you can have a look at the annual report. But we can see this line here is kind of a good average. Historically from 21 to 24 over 3 years, it didn't really go much above that 45 mark. And then it hits 60 and keeps going up to 100 and then comes back down within that period of time. So that's March 2024 to December 2024. So, really a 9 month period. And then it comes all the way back down to its lowest, which is really interesting, 10.8 now, which in general speak is actually quite low for price to earnings, but that is all relative. So what we're going to do for the purpose of this video, we're going to go through and take the higher point to be, I think there's enough period between March and June to say that 60 is the absolute highest and 10. So this is going to be really interesting when we calculate it. So we're going to have the lower PE at 10, the higher PE at 60, and then the average PE being 35. Now, the way I got to that 35, 60 plus 10 is 70. Divide that by 2 gives us a rough price to earnings of 35. So what we want to do next is calculate what our earnings per share is to give us some kind of range on the stock. So scrolling down and having a look at the analyst forecasts. Very interesting. Very interesting stock. So it looks relatively flat. What are the earnings per share doing? Oh, not a great deal. What have we got at the moment? They're 53 cents, 7 analysts, covered by 10 analysts, which gives us comfort. And looking at June next year, 51 cents is the earnings per share, and going out 56 cents and even up to 63. So it's not looking great in the next 12 months, but let's go um, earnings per share of 51 cents, making sure that we put that in there. So what we want to do now is calculate roughly what the bottom price is. So the bottom price is, we'll take the lower priced earnings, the 10, and multiply that by 51 cents. So we know that that's going to come out and be about $5.10. Oops. And then the higher amount, again, we're taking that 50 cents and multiplying that by 60. And go over here. So we've got 0.5 cents per share. Multiply that by 60, and it is coming up with $30 per share. And then let's average it out while we're here as well. And we've got the 35 is the average price to earnings, and the 51 cents per share. We're going to go through and call that roughly 17. So $17 per share is our magic number. Looking at hitting that mark within the next 12 months. Let's head back over to Simply Wall Street. And we've come up with a price of $17. And the interesting one is that wasn't too far off what that discounted cash flow was, $20. But it's also, it's trading under six and looking to go up three times. Very, very interesting if it does. It is quite a low price to earnings ratio. Like again, before this period here, where we're looking at the earnings and they're consolidating and they're getting rid of some of their brands and trying to make things work. But it hadn't really gone below 30 times earnings. So even here, 26, and even coming down now to 10. So really, really fascinating, this company. And we'll have a look in a minute at the chart and see what it comes up with. And certainly not even the next 12 months, but afterwards, if those earnings do go up and they are accurate and the price to earnings goes up as well, um, that'd be very interesting. But let's flick over. Um, and we're going to pull up the chart and just have a look at this range and see where it's been for the last 12 months. And we're going, looking at our low, looking at our high point. So our bottom price was $5, our high was 10 and 17 in the middle. So looking over the 1 year, bottomed out at 5, which is 5.93, which is kind of where it's at now, and definitely didn't get any high. Near 30, that'd be outrageous, and it hasn't actually got any higher than 10. It'd be interesting to see what the range has been. So it's never actually got up to that 17 before. Really only peaked at that $14, $15 per share. Let's see if we go back. Yeah, 17 is the absolute highest, 18. So it'll have to come back and hit an all-time high, which is before COVID, but more importantly, before all those tariffs. So that is the analysis on Treasury Wines. It's been very interesting. It's a little different to the other ones going through, particularly when you have, a price to earnings ratio that really jumps and spikes and going up to over 100. Whereas I think that's more about, the earnings per share going down, investors not being able to take on that for that period of time. But that $17 seems quite audacious, but then again, we've also got that discounted cash flow. So I think there is potentially some money to be made there. And yeah, just how much, whether it gets back up to the heights, all-time highs of 17, where that average would come in. But even coming up to that 10 seems somewhat plausible. But yeah, so that's the methodology applied to Treasury Wines. Probably doesn't give me as much confidence or clarity as it does as it has for some of the other stocks. But one thing that is giving me a bit more comfort is our price of $17 is similar to that discounted cash flow forecast of 20, which is usually really, really conservative. But as always, this stuff is based on forecasts and people getting that accurate. So if that's not accurate, then we're not going to be accurate either. So any more stocks you want me to cover, comment below, like the video, subscribe, all that stuff helps me get in front of a few more people to be able to create more videos like this. And anything that's usually a mid to large cap stock, if we go into the smaller cap ones, it's a bit hard because their EPS is a bit all over the place. And yeah, it's a bit harder to predict. But that's it, done and dusted Treasury Wines. Stay tuned for the next video coming up soon.